Hi, so one of the most popular investing books for the last decade is called The Little Book That Beats the Market by Joel Greenblatt. It's a fantastic book and I highly recommend reading it, but if you haven't read it before, well, don't worry, I'm going to go through and give it a full review today and explain what the magic formula actually is. Okay, so the concept behind the magic formula created by Joel Greenblatt is to make a list of companies that are both undervalued and good quality. So that sounds pretty simple, right? So the first thing we have to do is create a list of all the companies from most undervalued to most expensive. And Joel Greenblatt suggests that we rank these based on what's called the earnings yield. So the earnings yield, and it's essentially whether the company is making really good earnings and the value of the company is low compared to those earnings, well, it's a sign of a good deal. So we make a list of all the companies and we rank them by this earnings yield. So we have that list and now we make another list and we rank all of the companies, and this time we rank them based on their return on capital. Now this return on capital, well, it's a measure of how good the company is at making money with the assets that they have. So a factory that has $20 million of machinery and makes $1 million of earnings a year, well, that's $1 million divided by 20, which equals 0.05 or 5% return on capital. And then we have another factory that has $20 million of machinery, but makes $2 million of earnings a year. So that's 2 million divided by 20 million or 0.1, which is 10% return on capital. So 10% is better than 5%. So the second factory would be ranked above the first factory. So return on capital, well, is a really simple, basic measure of quality of a company. So now we have two lists. We have one where all the companies are ranked on their earnings yield and the other where it's all on their return on capital. So here's a demonstration of the two lists. Now, I've made 5 companies up here, but pretend this is done with thousands of companies on the US stock exchange. So we have our companies ranked on earnings yield and return on capital here. So now in the second table, what I've done is I've ranked them based on now what's called the magic formula number. That is the ranking based on the earnings yield and the return on capital. So if we look at Tiny Tulips, for example, Tiny Tulips came third in the earnings yield, but it was first in return on capital. So first place plus third place gives it a magic formula number of 4. Roses R Us, well, it was first in earnings yield, but it was actually fourth in return on capital. The 1 plus the 4 gives us a 5. Now, just like golf, the lower the number here, the better. So Tiny Tulips would be the best magic formula stock from this list because it has the lowest score. And that's how the magic formula works, but obviously on a larger scale. So Joel Greenblatt, the author and creator of the magic formula, is a value investor, professor at Columbus University, and runs the Gotham Funds hedge fund. He also started what's called the Value Investors Club, which is a 250 people exclusive membership group of investors who win $5,000 every 2 weeks for their best investing ideas. It's very famous. Now, I like Joel Greenblatt because he uses a very scientific and data-backed approach to his investing, and it's really not that complicated. And the magic formula that he created, well, it's very sensible and logical. So as Greenblatt stated in a 2006 interview with Barron's, the magic formula is designed to help investors with buying good companies on average at cheap prices on average. Using the straightforward, non-emotional approach, investors screen for companies that are good prospects from a value investing perspective. So the strategy is to follow this process. First, rank all of the companies and give them a magic formula ranking. Step 2, buy 2 or 3 positions each month in the top 20 to 30 companies over the course of a year. Step 3, now each year you'll actually need to rebalance the portfolio by selling off the losers 1 week before the year ends and then sell the winners 1 week after this 1 year mark. Now, the reason you do this and you sell off the losers first and then the winners a little bit later, is actually a tax strategy because once you go past 1 year, you get a reduction in what's called capital gains. And anyway, it's just a tax strategy. And then step 4, which is probably the hardest, you repeat the process each year for a minimum of 5 to 10 years, or hopefully more. So in the book, the back-tested period was from 1988 to 2004, which is a good sample size. And as you can see, the 33% return is exceptional compared to the market of about 15% over that time. This is some of the best long-term returns out there and why the book gained so much popularity. Now, the book was written some time ago, and a more recent backtest from 2004 to 2016, which included the 2008 financial crisis, shows that the magic formula strategy still was superior over the long term. But what I want to do is highlight some very, very important points. So if you invested in a strategy and followed the rules exactly in 2004, well, in 2009, 5 years later, you would have exactly the same as the S&P 500 index fund has returned as well. So you could have gone through all of this work, done everything perfectly for 5 years and still had no advantage. Now this shows you just how difficult it is to follow a strategy and that hardly anybody was able to implement the plan in the book, because you would lose a lot of respect for the method that hasn't really done anything for you for 5 whole years. But if you got through this difficult period and trusted the process, well, you would have been rewarded significantly, more than an index fund and most other investing strategies. Now this graph is even more interesting. See, this is the back test from 2015 to 2019. If you applied the same strategy, you would be far worse off after this 5-year period than the index funds. I find this really fascinating as the longer time frame has proven to work really well, but a shorter time frame, well, it can be problematic. So the strategy appears to have merit over, say, a long-term time frame, like 10 years plus. But because it's such a long time frame, it's so difficult to implement. So because it is so difficult to mentally stay with a strategy like this, I think it will always work. Think about it from a human psychology point of view. If you had 5 years of inferior returns, well, you're probably going to get fed up with that and you're probably going to make some changes to that strategy. And I bet after these 5 years, a lot of people just completely disregard the strategy anymore and just move on to some new approach. If I was honest with myself and I had 5 years of inferior returns, well, I would think I'm doing something wrong and I would probably look for an improvement in my plan. Because after those 5 years, well, I don't really want to wait for 15 years just in case. Like, what if I am wrong? What if this strategy doesn't work anymore? I don't really want to wait that big long time frame that really the data suggests you do need to wait that long. So the strategy I think is a really good one, but the discipline required to stick with it for such a long period of time, I think it makes it nearly too difficult. And that's why I think the strategy will always work, because generally most people is going to be way too difficult to stick to for such a long period of time. So even when artificial intelligence starts doing stock selections for people and running managed funds and following the magic formula, well, what'll happen is there'll be inferior returns for a period of time, maybe like the last 5 years, and people will still pull money out of these funds. So for those people out there who really just want a set and forget strategy and they have to just look at it probably once a year, well, this might be the perfect thing for you. So this is the Magic Formula website. So it's a very simple website to use. What we're going to do is we want to put in a number for the minimum market cap. Now, I like to start at 1,000 million. So that's $1 billion is the minimum market cap. And then the number of stocks, I like to keep it at 50. So then I just guess stocks and that's it. It just literally has ranked them for us. These are the 50 companies that would be the top 50 of the magic formula. So that's, remember, earnings yield and return on capital combined together, ranked on a new list, and this is that list. So here are the top 50 companies. And look, I've looked at a lot of these companies before, and you can see some of them here. I've got Alexion Pharmaceuticals. I've got Biogen. Big Lots is an interesting company that I've been looking a little bit at recently. What else have we got here? Anyway, Discovery's coming up on a lot of hedge fund managers and stuff. They've been investing in Discovery, so here it is here. Fox Corp, I've heard about that recently from one of my subscribers. And as you can see, there's a pretty substantial list here of different companies. So what I would do next is, it says, well, I've done 1 billion. So let's make it now 10 billion. And I get these stocks. So now we're talking pretty much large cap companies. So AbbVie, we've got AbbVie here, I can see. Amgen, we've got, well, Biogen's still on this list, which is good to know. You can see there's Intel now, Intel Corp. I've done a video on Intel before. So now we've got just the bigger companies. Something I like to do next is, now I've got a bit of a feel for what companies are here. Now let's go small. So let's go the smallest range we can do, which is 50 million. So now we're going to have pretty much nearly the entire market. So we've got small, very small micro cap companies, and we've got the big companies as well. So this will be a more, I think probably the best of the lists, but I like to see whether some of the big companies have made it into the smaller list as well. So Biogen. Biogen has come up on every of the 3 screens we've done so far. Biogen has come up on all 3. So that's a very good sign. I should then go and do some research, which if you've watched some of my videos, you'll know that about a week ago, I'm really bullish on Biogen. So another thing we can do is actually just sort them by 30 stocks. So now we've got a smaller list. So it's just the top 30 now. So that's probably plenty. You probably don't need to go much more than that anyway. So here are the 30. Now, don't overlook those smaller companies just because their market cap size is in just the $50 million range. Well, that's often overlooked by hedge funds and big investors, so I definitely want to look there. So let me explain exactly how I use this screen. Now, I use it as a starting point to do a far deeper research into a company. And there are some fantastic ideas here, and some of the companies on this list, well, I have done research on. Now, trying to stock pick like this does have its own disadvantages. I will definitely overlook some companies and make some mistakes because some of the companies that are on this list are just about to turn around and explode. But unfortunately, I'm probably going to rule some of these companies out for whatever reason. Maybe I just don't like the industry, or I think the business model is too complicated, or even I just see something wrong with the financials from my point of view. So the easier decision here is to just trust the back-tested data and just invest in the same methodology as Joel Greenblatt suggested, and don't worry about it for the long term. So do I trust this method? Well, honestly, I'm still undecided. See, I can see the science is staring at me in the face, and I can see that it will work over the long term, but I'm just still a bit unsure that a magic formula can exist. Definitely read the book for a better understanding into this strategy. It's a really easy read, and I'll leave a link in the description as well. I hope you enjoyed this video. Hit that like button for me, and I'll see you in the next video.